John Paulson was a fund manager from New York who founded the Paulson and Company hedge fund firm in 1994. Paulson and his team performed rigorous, data-driven analysis of the underlying assets of mortgage-backed securities and collateralized debt obligations. Just prior to the 2008 financial crisis, Paulson approached Goldman Sachs to assemble a synthetic CDO, dubbed Abacus 2007A-C1, in exchange for a $15 million fee. Goldman Sachs selected ACA Management, a well-known manager of collateralized debt obligations, to be the manager in the deal, and worked with Paulson to help select the securities on the CDO consisting mainly of subprime mortgages. Goldman then sold these securities to the tune of $150 million to IKB, a bank based in Germany. ABN AMRO takes some $909 million of exposure as well, and buys protection on its exposure. What these buyers didn't know was that Paulson was effectively shorting Abacus by entering into credit default swaps to buy protection on the CDO that he helped assemble. Once the mortgage market went into meltdown, IKB lost almost all of its $150 million investment. ABN is acquired by a consortium of banks, including the Royal Bank of Scotland. RBS eventually unwinds ABN's position in Abacus for $840 million. ACA Capital lost approximately $900 million. Goldman Sachs, who themselves had some portion of the CDO on their books, lost about $100 million, netting to an $85 million loss considering their license fee. The SEC sued, alleging that Goldman Sachs Vice President Fabrice Touré misled ACA into believing that Paulson and Company invested approximately $200 million in the equity of Abacus, indicating that Paulson and Company's interests in the collateral selection process were closely aligned with ACA's interests. Goldman Sachs eventually settled this suit, paying $550 million to the SEC, conceding that their marketing materials were incomplete, and failed to disclose Paulson's adverse interests and role in selecting the securities. So, who won in all this carnage? John Paulson's hedge fund Paulson and Company made about $1 billion from this deal and were not named in any of the SEC's charges. Overall, it is estimated that Paulson and Company made $15 billion from their bets on the subprime mortgage crisis. All this reportedly garnered Paulson a personal payday of $3.7 billion in 2007, among the largest in history.